Hello, everyone. Today I will walk you through Draft ESRS 1 general requirements that launched in November 2025. So this is the official ESRS 1 document and incorporates all the key amendments that introduced in the last quarter of 2025. So the updated version significantly simplifies the framework by reducing various data points and easing several reporting requirements. To make this easier and to follow, I have converted the whole documents. You can see the whole uh, table of contents from ESRS standard and drafting conversations to fair presentation. Third is double materiality related stuff, due diligence, reporting period, preparations of sustainability informations, and so on. So I have convert the detailed document and the new amendments into the fair and understandable the presentations you can see here, which we will cover in this module 6, and we will cover the ESRS 1 as well as ESRS 2, which is a general requirement and mandatory requirement for any kind of CSRD obligations company for the sustainability reporting stuff. So let's start on that side. So ESRS 1 established the foundation principles that governing sustainability reporting under the Corporate Sustainability Reporting Directive, that is called as a CSRD, as we already seen in module 1, 2, 3, 4, 5. And its objective is very much clear, as you can see in the slide as well, to specify the sustainability informations required by the Accounting Directive as amendment by the CSRD. So the core mandate is to ensure the fair presentations of all the material impacts, risk, and the opportunity. That also called as the IROs, which is impact, risk, and opportunities. That relating to the people and the environment, and importantly, the primary user of this whole information that extend beyond the investors, and that covers lenders, business partner, trade union, civil society, and other stakeholders as well. So ESRS 1 sets the architecture and the conceptual backbone for the entire ESRS framework, and we will see the each and every standard of ESRS 1 as well as ESRS 2, what kind of objectives and the goal they are providing for the mandatory reporting work. So in the first things, the standard architecture and the drafting conversion, you can see that lots of hierarchy standards here you can understand by the cross-cutting standards, various top layer and cross-cutting standard of ESRS 1 that is called as a general requirements, and ESRS 2 that is called as a general disclosure. So these apply to all the undertakings who are eligible for the CSRD uh, reporting work. So the middle layer that consists of topical standards. Topical standard is also covers the environmental E1, E2, E3, E5 that covers various types of topics we will see in much details. Social that covers S1, S2, S3, and S4. Governance that is covers the G1. So the bottom layer includes entity specific disclosures which must be provided where material IROs are not sufficiently covered by the existing standards. And on drafting, whenever you are doing a reporting work, the language of compliance should be very much precise. So here you can see the shall disclose indicates the mandatory requirement. Shall considers indicates the guidance elements, and bold italic terms are defined in the glossary. So these are the stuff that language of compliance should be precise. So you have to mention in your ESG report when you are doing a CSRD report. Regarding the IRO definitions, in terms of I, that stands for the impacts that refers to actual or potential positive or negative effects on the people or the environment. And the risk, that is stand for the R, risk and opportunity refer to financial effects that covers performance, cash flow, and cost of capital. So this architecture ensures this consistency while allowing flexibility over the entity-specific material uses. Now we have to consider the fair presentation. So here you can see the fair presentation related definitions, and in chapter 2 of the ESRS 1 requirement, the fair presentation is the cornerstone of the ESRS. So it requires a complete, neutral, and accurate depictions of your material that impacts risk and opportunity. That applying ESRS standards alone does not automatically guarantee your fair presentation. So if standardized disclosures are not sufficient, then the undertaking must provide additional entity-specific information. So information must be a comparable, verifiable, and understandable. So it is also important to note that compliance with ESRS does not exempt undertakings from the EU legal obligations. So in essence of ESRS 1, the demand not just a technical compliance but decision useful sustainability information is very much required. So here you can see the applying ESRS including the material filters plus entity specific disclosures that needs to be understood by requirement of additional entity specific informations that covers overall presumptions of fair presentation. So here ESRS standard that developed by EFRAG has clearly mentioned that what is the meaning of fair presentation. Now we'll see about the double materiality, that is cover overall conceptual foundation. So part one is the conceptual foundation. So double materiality is the defining features of ESRS, which is a very important. In module 5, we already seen that what is the meaning of double materiality assessment. So there are two interconnected pillars. First, impact materiality that covers inside out perspective. So this assess how the undertaking affect people and the environment. So assessment considers severity, scale, scope, irreversibility, and likelihood. For human rights impacts, severity takes that over the likelihood. And second, that part of the financial materiality that outside in perspective. So this examining how sustainability matters affect financial performance, their positions, or the cost of capital. So assessment consider likelihood and magnitude of the financial effects. So these two lessons and the lens are interconnected. So impacts can create a financial risk and financial dependencies can intensify the impacts. So together they expand reporting from shareholder focus disclosure to the stakeholder based accountability. Now for the part of the materiality, double materiality, how this implementation and assessment can be done. So this slides illustrates the operational process. So step one is understand that what are the steps that we need to understand about the double materiality assessment. So assess the context. First, you have to assess your context, activities, and the business relationships. Step two, identify. You have to identify the both top-down strategic analysis and bottom-up operation assessment as well. So based on this approach, you can identify the various stakeholders. Step three, assess. That covers apply severity and the likelihood criteria to determine materiality. So, which materiality risk is part of your company's corporate material. So, the materiality filter means non-material topics needs not to be disclosed. So, however, omissions can be also mentioned in the ESG report. So, particularly in climate, you may require explanation. So, after the implementation steps, you have decided that climate change is not your part of the materiality risk for your company. So you have to explain and require explanation in your report. Then you have to do a stakeholder engagement, which is a very critical, that affected stakeholders provide essential input for impact materiality. They will mention which type of material risk needs to be considered from your employee, from your board, from your senior management, and they will mention the particular risk that is very important. Some of that stakeholders mention that climate change is the most priority for them. Some of that employees might be mentioned that social well-being is the priority for them. So based on that whole survey, you can decide which material risk has the most top priority, and based on that you can assess the whole materiality assessment. So nature is treated as a silent stakeholder. So you have to consider the nature as a one of the stakeholders, and you have to think from nature perspective. So materiality assessment must be updated at each reporting date, mostly financial year, similar kind of financial audit. So this transformations materiality from static exercise into the recurring governance process will help you to understand the whole scenario of sustainability reporting. The fourth one is due diligence. So now you have decided about the materiality assessment. Now you have the all the material topics. You also decide the impact, risk, and the opportunities. Now you have to mention the due diligence. So ESRS 1 integrates sustainability due diligence principle. So the due diligence cycles include identify, prevent or mitigate, then track, and fourth one is a report. So this four steps is part of the due diligence cycles, and that aligns with UN guiding principle on business and human rights as well as the OECD guideline. So the key distinctions in ESRS that requires reporting on the outcome of due diligence, and it does not mandate a specific conduct. So that obligations steps from the CS triple D. So this whole due diligence comes from the CS triple D, and due diligence inform the materiality and the prioritizations of actions. So thus the reporting reflects process maturity and the effectiveness. So for the due diligence, you have to identify first, then you have to prevent or mitigate, and then you have to track your whole stuff through your metrics and targets, and then you have to report in your financial annual reports. Then the fifth one is reporting boundaries and value chain. So here you have to understand about the approach. For reporting extends that beyond the legal entity. So it includes your own operations that align with financial statement boundary. For example, some of your investors covering the whole operations, then all the emissions and all the material risk are part of their responsibility. So that is one point. Second is upstream and downstream value chains. You have to analyze the upstream and downstream value chain from where your product raw material is coming from, and from and to where you are going to sell or dispose your product, that is part of downstream value chain. And third one is a direct and indirect business relationship. So some of that procurement can done by direct, and some of that procurement done by the indirect business. So these three things needs to be understand for reporting extends beyond the legal entity. Then material IROs must be reported regardless of where they occur in the particular value chain. So as I mentioned in the three particular points, you have to understand where your material risk lies. And the data hierarchy converts into the two part, that direct data from the value chain actors, that is from upstream or the downstream. And if the data is not available, you can utilize the estimates, proxies methodology, or the sector average, which is available in the market, or you can also develop your own assumptions, but you have to mention all the stuff in your annual report. So associates and the joint ventures are included wherever it's relevant. And based on that, you can decide your overall legal entities boundary. So This whole process reinforce accountability beyond your operational control and recognize the systematic sustainability risk that helpful for the reporting boundaries and your value chain. Then the six is time horizon and the base years. So this is very important that ESRS requires clarity on the time horizon when you are doing overall reporting work. So the base year is historical reference. For example, you are doing a reporting work in 2026 and you have taken your base year in 2020 or 2022. So that is called as your base year. The second one is a short term that might be up to 1 year or maybe 2 year. If you are reporting in 2026, then you can uh, plan your opportunity and risk for the short term period up to 1 or 2 years, and you can mention, mitigate, or adaptations projects in that whole strategy. The third one is a medium term, which can be the up to 5 years. So you have to mention the 5 year plan that your goal for the 5 years, what can be the medium term goal, and the long term beyond the 5 years. So it can be the up to 10 years, up to 7 years, and more than the 10 years. That part of the long term goal. So this align broadly with financial reporting cycles, but allow flexibility where industry cycles justify the alternative definitions. So any deviations must be disclosed in this whole goal plan, and this ensure the forward-looking transparency while maintaining the comparability for each and every terms of goals. Then the seventh one is preparation for sustainability information. So when you are preparing for the your annual report, that is covers uh, sustainability information. So you have to understand that each and every chapter address the data quality and the principle that used for the preparations. So comparative information. So you have to mention the previous period data that must be disclosed for quantitative metrics and estimates and uncertainty as well. Uh, so permitted when direct data is not available, and assumption and uncertainty must be disclosed. As I mentioned, that you have to disclose your whole emissions factor or your assumptions in your report, and undo the cost or effort relief that already provided by the ESRS, that is strictly limited as per the provided by the ESRS, and that allows use of secondary data but does not remove reporting obligations. That is also the main point that you have to keep in your mind. So prior period errors can be material errors, require restatement of comparative figures, and this requirements elevate sustainability reporting towards your financial reporting process. So these are the things that you have to keep in your mind when you are preparing your sustainability information. The eighth one is a structure of the sustainability statement, that how your report should look like, and as per the CSRD and ESRS standards, how the structure of the sustainability statement should look like. The sustainability statement forms part of the management report, so it structures include overall general informations that we already seeing here. This is a very general informations that needs to be done. We will see in detail what kind of metrics and targets that you need to disclose, but first one is the general information that should covers the governance, strategy, and materiality. Second one is the topical standards, that environmental disclosure. Under that, lots of metrics and metric analysis and the target analysis you should disclose. That covers E1, E2, E3, E4, and E5. We will see the what is the meaning of E1 to E5. And the third one is a social disclosure, that is S1, S2, S3, S4. And fourth one is a governance disclosure, that is part of the governance conduct for the G1. So the presentations requirement must be a human readable and must be digitally tagged, that machine readable. So because ESRS and the CSRD that develop that helpful by the FRUNC that covers the digital reporting through the XBRL, we will also see that how you have to report digitally. So the executive summary is optional, but I would like to suggest it is recommended for every investors and lenders, so that executive summary should be there in your report. Also, the EU taxonomy disclosure are incorporated, so you have to also understand about the KPIs of EU taxonomy, and this ensure that integrations between the sustainability and the mainstream reporting with other type of framework. And the after the sustainability statement, you also have to understand the general requirements of connected information and the financial linkage. So here this chapter introduced the concept of the connectivity. So under uh, users must understand how sustainability matters affect the financial performance, as I mentioned in the double materiality assessment, that what are the financial effects of your product or your service when you are doing at market level. So consistency is very much required. So assumptions such as inflation or growth rate must align across sustainability and financial report. So if your entity disclose a financial audits and various balance sheet and the assets and liability, and your different sister company is disclosed under the sustainability reporting. So that is a very mismatch. You have to align with your financial reports that this is the entity and this is the balance sheets, this is the asset and liabilities. And similarly, you have to also mention the same um, holding companies related or sustainability things, and whatever assumptions you are taking during the financial reports, similarly you have to also consider those kind of assumptions that relevant to sustainability in your sustainability report. The second one is a direct connectivity. So cross-reference specific financial amounts, for example, CapEx, OpEx that allocated to transitions plan or adaptations plan projects or mitigations projects. You have to uh, tag those kind of financial amount into the direct connectivity. The third one is the indirect connectivity, the explain relationship to aggregated financial figure that might be utilized or might not be utilized, or you can get some subsidized from the government. And the fifth one is incorporation by reference is allowed in limited case to avoid the duplication. So this whole things breach sustainability and the financial reporting very well, so that financial requirements and the sustainability requirement can meet the target and meet the goal of CSRD and ESRS standard. So that is covers under the chapter 9, and you have to understand the sustainability statement and the financial statement connectivity, and this whole points are part of this whole connections, means it means the breach of this whole sustainability statement and the financial statement. And the 10th chapter that covers transitional provision. So in transitional provision for first wave undertaking. So uh, first wave of company that are have 1,000 plus employees and 450 million turnover euro turnover. So for that, what can be the first wave undertakings and transitional provisions provided by the CSRD and ESRS standards? So that is covers the comparative data. So that is not required in the first year. Entity specific disclosure, so that is a temporary relief on granularity. So there is a no much detailed informations related to that entity specific disclosures required. So you can mention the overall vision missions and the overall informations for your entity specific phasing that include scope 3 GHG emissions over a 1 to 3 years. So if you are into the first wave of company and you are going to report in 2026, then you can uh, start your journey for scope 3 emissions now, and after 2 years you can disclose your scope 3 emissions. That will be fine. Second is anticipated financial effects. So narrative can find only for the first 3 years. So that is there. So financial effect, it means what are the financial effects of your products and the services for the first 3 years, and then you can decide based on the uh, narrative, and after the 3 years you have to disclose the particular amounts of financial effects. Third one is a social matrix for value chain workers may be deferred, so that it helpful for you that how social matrix for value chain is work. And these provisions acknowledge implementation challenge while maintaining the directions of travel. So this provisions is helpful for the first wave company, which is undertaking as a wave one company, and based on their eligibility criteria, this is mentioning in the first ESRS general requirement. Now, there is a two appendix in ESRS S1 draft November 2025 standard. So that is, as I mentioned in the hierarchy, that list of topics that materiality universe can be done. So across these topics, you can do a double materiality assessment through your stakeholders, and you can make a chart or make a graph, and you can prioritize your material, which type of material is priority for your company, and based on that you can decide your risk and opportunity. So here is the list of topic that we will see in near module about the environment, social and governance. So even that stands for the climate change, and that covers mitigations, adaptations, and energy related metrics and data points. For E2, that covers air, water, soil related pollution, and that substance of concern about the pollution. E3 that covers water and marine resources. So E3, who is into the ship transportations, that covers E3 is very much in detail. For E4, biodiversity and ecosystem, that how nature assessment can be done for your sustainability reporting requirement. And E5, that is circular economy, that how material resources that you are using for your services and the products. In the pillar of social, S1 that stand for the own workforce, that how much employees you have, gender and related information. S2 is workers in value chain, that covers whole life. S3 that affected communities. If you are working in coastal area, then what are the impact on coastal communities? S4 that stands for the consumers and end user, that how it will helpful for the consumers and end user. And the third pillar is governance, that covers the G1, which is part of the business conduct, culture, anti-corruptions, money laundering, and payment practices, that you have to develop your policies internally. Appendix B, that is quantitative characteristic of information. So what are the fundamental qualities that you need to mention about in your report that covers overall quality? So information must meet a qualitative characteristic, that is first requirements. So in the fundamental, relevance is predictive and confirmatory value. You have to do a faithful representations, that complete, neutral, and accurate, and enhancing through your comparability and verifiability and understandability. So this principle aligns well with the sustainability reporting with your financial reporting, and conceptual. It is helpful for compare the overall financial statement and the sustainability statement. And here. That covers 1 to 10 chapters of ESRS 1 that we already seen each and every stuff that we cover. So in ESRS 1, what kind of drafting conversations, what are the fair presentations, what are the preparation for sustainability information. So we cover whole stuff, and what are the amendments in the each and every stuff that we already mentioned. So that is a very basic general requirements of ESRS 1 that help you to uh, prepare for CSRD and ESRS based reporting work. So in overall summary and strategic implications, here we understand that uh, from voluntary to mandatory, from shareholders primary to stakeholder accountability, double materiality expand both risk and impact perspective. So you have to do a double materiality assessment very well and very strictly and very thorough. So the call to action is very much clear. First, you have to review your business model through the double materiality lens. Second, define your value chain boundary that immediately impact your investors, your operational control and other stuff. So based on that, your boundary limit will be decided, and based on that, your emission boundary is also going to decided. Third is establish connectivity between sustainability and the finance function. So you have to understand what are the sustainability statement and the financial statement. And then compliance with ESRS 1 is not a merely a disclosure exercise. It is just a general requirement. So these are the basic requirement. We will see much in detail for the each topical standard. What are the detailed requirement? It is the integration of sustainability into governance strategy and capital allocations. So yeah, thank you very much for your time. And this is the end of the module 5.1, which is part of the ESRS S1 general requirement. In module, sorry, 6.1, in module 6.2, we will see the ESRS 2, and that covers a general requirement for the ESRS, that comprehensive reporting requirements under the CSRD. Thank you very much.